Good day, and welcome to Toronto Transfer's weekly wraps. I'm Viv Govender, and what we'll do as usual is cover some stories from the week that affect you and your investments, as well as a little bit of a tech roundup at the end to just give us a bit of an update of what's happening in that particular sector. So our stories for this week are going to be as follows. Oil prices. We're looking at what's happening with the oil prices this week, having broken a multi-week rising streak. What's the latest in the Russia-Ukraine situation, and a bit of an update on China. I think that's a developing story that we need to keep an eye out. And in AI, I'm just going to cover some of my views on what the AI sector looks like at the moment, and look at why I still think it's an important component of your portfolio. Starting off with the oil price. Oil prices came down a little bit this week. They were rising for about 7 weeks in a row. And one would expect a bit of a pullback to come through. Things that were blamed for this pullback were what's happening with the US Fed, as well as what's happening with regards to the situation in China, which we'll cover a bit later. Basically, it comes down to the US is a bit too strong in terms of its economy, and the Chinese are a bit too weak in terms of their economy. The strength in the US economy means that it's less likely that the US central bank is going to be able to cut rates anytime soon. And there's even fears, coming up, very minor fears, mind you, but fears coming up that they might be looking to raise again. Very, very minor, like I said, but not exactly a great trend. So why is this important? Because oil prices, especially in a place like South Africa, are a big input for inflation. If you look at what's happened with regards to the inflation rates, both locally and internationally, you've seen inflation come down, significantly. U.S. inflation from like above 8 to just 3.2 last period. The previous one was actually 3. You've seen the UK inflation fall as well, Netherlands, etc., all coming down, but they've come down to levels that are still reasonably high. Even in South Africa, we are below our 3 to 6% target, but the Reserve Bank has been very clear that its target is actually 4.5%, the midpoint of 3 to 6%. And we are still above that. We're about closer to 5.5 to 4.5. And why is this important? Because if inflation is going to be making a bit of a return, because remember, oil prices up 20% just about in the last 2 months. That's going to feed through to a lot of energy prices. And it's going to turn, into a problem, I think, if it doesn't, calm down a little bit. You combine that locally with a rand that's above 19 again. We're talking about a 5-10% move from where it was, a few like a month or so ago. That 20% higher oil prices, 10% weaker rand, that doesn't exactly all go well for South Africa's inflation rate going forward. And another thing I want to point out is that we always talk about commodities, but I've always said to you guys that the one thing that really determines whether inflation sticks around or not is wages. If wages start to increase, then we are going to be seeing a long-term impact on inflation, because wages don't go down. The oil prices went to 120, came back to 70, went to now 85, can go back to 80, no problem. Wheat prices have come down significantly. Wages don't. And why did I bring this up? Well, there was a recent story that UPS, it's a delivery company in the US, like FedEx, they basically, what they've done is come to an agreement with their drivers around what they will pay them, the next period. And this is the actual, result of that. In 5 years' time, at the end of this particular agreement, the average full-time driver at UPS will be getting $170,000 in benefits and salary in a year. $170,000 is roughly 3 million rands. It's actually more than 3 million rands per year as a delivery driver. In terms of benefits, it's just cost to company. It's like if you're making say 250,000 rand a month, cost to company. That's what it's like. That is a clear indication, in my point of view, that wage inflation is starting to raise its head in the US. That $170,000. The US is a richer country than South Africa. $170,000 is well above the the average wage in the US. Minimum household income is roughly a third of that, quite frankly. So it's a huge improvement. It is for delivery drivers. I'm not saying this is an unskilled job, but it is not a job that requires a degree. It is basically blue collar work. This is a very, very significant, I think, move. And meeting another strike likely to happen in the motor sector, automobile sector. UAW, the auto workers, is going on strike. That's probably going to also result in significant increases. They are framing this, and so do the UPS guys as well, as if that they've basically been giving their companies a break for too long, and now they need to basically catch up to where they were before. And so I think that this is something that we will be seeing in the US over the next year or so, greater and greater detail, because they have a 3.5% unemployment rate. They've had inflation outpacing wages for the last couple of years. You can't have a 3.5% unemployment rate and have declining real wages. People are not stupid. They will eventually try and ask for higher wages because they know there's nobody else to take their jobs. Okay, so that is that situation. The next thing is the Russia-Ukraine thing. A couple of developments there. It's pretty clear right now. I mean, even like the New York Times and CNN, etc., guys that are generally pro-Ukraine have admitted that the military strategists are looking towards next year. The way this war works, it's like an old-fashioned war. You can't really do much stuff in certain times of the year, and it's coming to the end of the time of the year that they can really do the kind of stuff that, or they've passed a period of time of the year where they can do like the really big moves. There was a fighting season when it was not too cold and not too wet that you can move around. Because Ukrainians were on the offensive this time, the Russians were on the defensive. Last time around, it was the Russians on the offensive, the Ukrainians on the defensive. And it appears that in both cases, the defensive side has a huge advantage in this conflict. So last time around, the Russians lost a lot. This time around, the Ukrainians have lost a lot. And they've not done much. So when we go to winter in a few months' time, what we'll likely find is that we'll be reviewing these tensions again next year. That is something I think we're going to be seeing for a while. I mean, these wars are never quick. I mean, even when you have a totally outmatched enemy like the US had in Afghanistan, 20 years later, it was still ongoing, and then the US actually lost. Iraq, Syria, these wars are not easy to win and not easy to basically, sort out. So that's developing, into basically a stalemate. What else has happened there? They've opened a humanitarian corridor to get some of the ships that have been trapped there since the start of the war from some of the Ukrainian ports out. The general consensus is that the Russians are going to try and attack Ukrainian ports going forward. The reason being is that it's going to cut off, a huge source of what they believe is a source of imports of, weaponry and whatever, and also kind of a huge source of that economic power it has in terms of exporting grain and so on. Obviously, that's a war situation, but in terms of the impact on the rest of the world, not great, because if the Russians take out the Ukrainian, exports, it does affect global food prices, which are not going to be looking great. And like I said, we are seeing already oil prices rise. So the Ukrainian war, this round seems to have gone to the Russians. It seems to be a stalemate, however, that's going to be lasting at least until next year, and everyone's kind of preparing for the next round, quite frankly. And then I just want to talk a little bit about China and what's happening there, as well as just give you guys an idea as to why I'm focusing so much on China. China is the second largest economy in the world. It is a huge source of demand for raw materials. I mean, in terms of its economy versus the amount of imported raw materials, it's actually imbalanced here. In many cases, China demands almost half, in cases more than half of a certain class of raw materials. The reason being is that it's developing from a very poor level to a very rich level, or was developing from a very poor level to a very rich level. It was basically, demanding resources to basically build up its infrastructure to a level that was commensurate with what its economy is looking like. That period may have passed a few years ago, but the momentum of building infrastructure, etc., continues, and therefore China is still a huge source of demand. And I've done an article this week, and it basically highlighted 5 points as to why I think you don't want to be investing in China. Okay, and they're quite simple. It goes like this. Firstly, Xi Jinping is very old. He's got himself in power for life, effectively. He's changed the constitution to say that he is his thoughts are part of the constitution. So there's no higher authority in China than Xi Jinping, including the law. That is another great recipe for success. The Chinese have many tech startups, many unicorns. Unfortunately, they're all trapped in China, And if Xi just takes for whatever reason gets on the wrong side of the bed and decides that your particular company or your particular class of companies, as this is done in the past, don't quite match with what it wants, you're gone. Compare that to the US, where they have a tech startup sector that have people that have really strong agreements and disagreements with either political party, many more anti-Trump, but some even anti-Biden. And those people basically are able to go out and conduct their businesses without any problem at all. So yeah, the problems in China around leadership, I think, are bad on their own. The next 20 years, maybe longer, would be ruled by a person that's aging. A man in his 90s with absolute power does not run the world's second largest economy very well. Next thing, we are seeing the demographic shift in China really, bite into them at the moment. They peaked in terms of working age population back in 2013 to 2015. It's about a decade ago that they had the highest working age population that they're likely ever to have. Right now, the working age population is declining. The overall population is declining. This is a very bad situation for the country. They got old before they got rich. Japan got old, but it was rich first. So now they're going to basically just kind of go into the sunset and in a golden retirement almost. The Italians, same kind of situation. They're rich and they're getting old, but they're not having a terrible lifestyle. The Chinese are still reasonably poor. They're richer than they were, no doubt. I mean, they've raised hundreds of millions of people out of poverty. The biggest poverty reduction effort ever in history. But they are still poor in Western terms. They are nowhere near a situation where they can actually have a peaceful, a comfortable retirement like the Japanese and the Italians have. Even those places, they have issues. Chinese issues are much worse. And the demographics look terrible. It's not a case of they can change it in a year or two. There are literally not enough women of childbearing age in China that a reasonable level of fertility would suffice. These guys would have to go to 3-4 children per woman, well above the norm at the moment in China, in order to basically stabilize the population of China, getting back to a reasonable balance in terms of working age to elderly population. That's not going to be happening. So yeah, the Chinese demographic situation is bad and getting worse. The property situation is also starting to really bite into the thing. Another company, Country Garden, came out recently with it's called restricting the sale of its bonds or trading its bonds rather. Restrict trade of your bonds basically. Indicates that you have a situation where those bonds may not be honored, and there's fears there could be a run on them. This follows up on Evergrande from a while back. The property sector in China, for those that understand, didn't exist 50 years ago. It was a communist country. You couldn't own private property. Since about the late 1990s, the property sector has really started to take off. And in the last, say, 20, 25 years or so, we've seen basically the property sector grow from almost nothing to account for 30% of the country's GDP. 30%, 1/3 of China's GDP is in the property sector, and 70% of household wealth is in property. A property crash in China would have such massive impacts across the entire country. It could easily destabilize it. We saw that happen already when one of the regional banks a little while ago basically wasn't paying people back because of some of the property loans it had given out, but defaulting, it couldn't pay them back. They hadn't enough cash. And we saw people willing to go up against the police, willing to riot. Why? Because there's no real social safety net in China. If you basically don't have your savings, don't have your retirement savings, your life is horrible. You're lost. And people basically can be cowed, but they can't be cowed at the point at which they have nothing else to lose. And that's a huge danger for China. The next thing is Taiwan. Taiwan is a massive risk because the Chinese have always come out and said that they believe Taiwan's a wayward province. They want to bring it back into the fold. Taiwan's been a country for longer than basically many countries in the world have existed. Just founded basically after this Chinese Civil War of the 1940s. So we're talking about a real country with real power, 23 million people living there, tiny compared to China, of course, but a real country, incredibly powerful in terms of its impact on the global economy because of its the demand for computer chips. This thing Taiwan rather produces like 90% of the high-end computer chips in the world. The highest tech computer chips, 90% produced in Taiwan. Even of the normal semiconductors, they produce like half of it. Semiconductors, computer chips are as important to the global economy right now as oil is. The world has gone to war over oil plenty of times. Even in World War II, a lot of the decisions made by the Allies and the Nazis, etc., the Axis parties were about oil, right? Oil chips are, computer chips are as important to our current economy as oil is. And if the Chinese do invade, putting that risk, that supply, we will see having an impact in terms of the global willingness to confront them. And finally, if we do see either this situation in China break out and cause an issue, or the situation in India break out and cause an issue, or the situation in a number of other different places where the Chinese have conflicts with their neighbors break out and cause an issue, China could face the same kind of sanctions that the Russians face. And if the Chinese face the same sanctions the Russians face, us as outside investors will have the same results. If you had bought a Russian ETF, last year before the invasion, it's now effectively worthless because you can't get those assets. Those assets basically exist. The Russian economy may be growing, reasonably. It's actually a bigger economy now than Germany is, but it doesn't matter to you because you don't get those assets because they are blocked by sanctions. And despite what everyone says about BRICS or whatever, South Africa is firmly in the Western US system, okay, the US/Western system. We basically care more about dollars than we do about yuan. Everyone knows what the dollar rate is now, 19 some change. Very few people even know what the yuan rate is. Everyone goes to holidays in like Western Europe or in the US. People look at retirement in places like Australia or New Zealand or basically in Canada. These are all part of the Western economic system. No one's looking to basically go and very few people looking to go and retire in Beijing or something. And so we are looking at a situation where if things do turn very bad and we do have the issue with regards to sanctions and cutting, our investments there would be worthless. Okay. Here's my AI take. The AI portfolio started to be implemented about a month ago. It's down slightly at the moment, just about 5% or so from the start, and that's because some of the AI stocks, especially things like Tesla, have come down significantly. But I want to be reassuring you that the strategy behind the portfolio is not about short-term gains or losses. We are looking for the longer term. The short-term gains or losses are more due to things like, for instance, fears about interest rates, fears about this short-term economic growth, etc. I truly believe that this is a long-term technological revolution that's going to have an impact at least as large as the internet, and probably larger. Satya Nadella came out and said basically there's a famous Bill Gates memo that he sent out in 1995 about the internet and about how it's the next big thing. And he says, Satya Nadella now says that, read that email or read that memo, he sees the current situation has been very similar to what was happening back then. I think actually it might even be larger. There's more potential for AI than there is for the internet, or there was for the internet. That is what we are basing the strategy on. It's not about the short-term movements in the stock market. It's not about the short-term fluctuations due to interest rates, etc. It's about the long-term, multi-decade-long technological progress that we are expecting to see. And to give you an idea as to what my thesis around this particular thing is, it's as follows. The most advanced system at the moment, the peak of AI technology, is GPT-4. GPT-4 is virtually an amateur system. It's built with $100 million of investment by a team of less than 1,000 people, okay? And it was built 2 years ago. There's no way that once you add on the kind of investments we've been seeing in AI, from Apple to Microsoft to Meta/Facebook to Alphabet/Google to Amazon to the rest of the world combined, which are now, we're talking about investments that are 100 times more than what were in the ChatGPT or the GPT-4 training budget. Plus, we are seeing more new chips coming out that are going to be specifically designed for AI. We're going to have an improvement in the cost efficiency and an improvement in the amount of money. I would say it's probably going to be maybe 100 times more effort and more ability being put into these new systems within the next year or two than was put into GPT-4. 100 times. I think it's very unlikely that we are at anywhere near the end of this particular cycle. So yeah, things have come down a little bit, like I said, 5% or so, but the underlying investment case remains very, very strong. Okay, thanks for joining me. I look forward again to see you guys next week. Cheers.